Hi, I'm James Robinson, and this is my stock pick of the week. This week's stock, we're going to talk about the company Activision Blizzard. The symbol is ATVI. Today is July 1st, 2022, and before I get into the company Activision Blizzard, I want to talk about my absence from YouTube. I haven't posted a video in 255 days. I stopped posting because I felt that the market was just too overbought. I really just didn't find any companies that I thought I could suggest you should buy in good conscience. Just everything felt really expensive to me. I didn't know that the crash was coming in January when it did. Although I did post a video in February of last year saying that I thought it was inevitable it would happen sooner rather than later. But I was pretty highly invested in January like everybody else. And I've taken my lumps this year like everybody else, although I'm only down about 6% compared to the much bigger numbers for the rest of the market. Since my last video was posted on October 19th of 2021, the NASDAQ is down from 375 to 277. That's a drop of 26%. The S&P's gone from 4536 to 3771. So that's down 17%. And the Dow has gone from 35,609 to 30,693, which is a drop of 14%. So I've done better in the market, but I've still gotten hurt like everybody else. And I feel good about the fact that I didn't tell you guys to buy any stocks for the last 255 days, because I think anything I might have told you to buy, we would have lost money on. And that's part of the discipline you want to have as an investor, is the ability to simply say, hey, there's nothing out there right now. And as we look at the market today, I'm going to be starting to post regularly again, because I think there's a whole bunch of good companies to buy. And that's the thing. You just have to have patience when the market is really overbought and say, look, I'm going to check out and go do something else and wait, because the market will correct. Maybe it takes a year, maybe it takes 2 years. But when it does, the options to buy are so fantastic that it makes up for all that time of inactivity. The hardest thing to do as investors is to do nothing. And sometimes that's exactly what you should do. Okay, now onto this stock, Activision Blizzard. Today is July, as I'm doing this analysis, July 3rd, 2022. So all of these numbers are effective as of that date. The market cap for Activision Blizzard is $61.43 billion. It has revenues of $8.3 billion, profits of $2.48 billion. Its PE ratio is 24.94. It has a yield of 0.6%. The company has $3.6 billion in debt, and it has $11.3 billion in cash. So the debt's about 18 months income. I don't consider that a significant debt load, especially not when you have more than almost 4 times that amount in cash. The company is a member of the S&P 500. You may remember last year, I had stopped trying to buy companies in the S&P 500 because I felt that it was so overbought. I no longer feel that way. I'm ready to buy companies if I think they make sense, whether they're in the S&P 500 or not. So a little bit more about Activision Blizzard. Most of you will probably know this company. They make Call of Duty, they make World of Warcraft, they make Candy Crush. They've got a bunch of very significant franchises. They're the 5th largest maker of video games in the world. So it's a company we're all familiar with. And so all of this really is not why I'm suggesting you should buy the company. The reason that I'm suggesting you buy the company is because I think there's a fantastic risk arbitrage for this company. So what does that mean? Well, arbitrage is the simultaneous buying and selling of securities, currencies, or commodities in different markets or in different derivative forms in order to take advantage of pricing differences for the same asset. So in English, there will be times that a commodity or a stock is priced on 2 different markets at different prices. Kind of the old classic traditional one that you'll hear about as you start to study arbitrage is buying London or buying oil on the New York market and selling it on the London market. And there'll be a few pennies difference between the values of those 2 things. And so that arbitrage is the difference between those 2 markets. And you very seldom make big profits on arbitrage. Often the profits are very, very small, but they're 100% guaranteed. The problem is that in order to get those profits, generally people take on a lot of debt, and then it's 100% guaranteed until something goes wrong. But that's what an arbitrage is. That's not the same thing as a risk arbitrage. So risk arbitrage is a form of arbitrage. It's also known as a merger arbitrage. It's an investment strategy to profit from the narrowing of the gap of a trading price of a target stock and the acquirer's valuation of that stock in an intended takeover deal. So again, that's the definition. But basically what happens is Party A says they're going to buy the company. So in this case, Microsoft has said they're going to buy Activision Blizzard. And they've cut a deal. It's a signed deal. and it's at $95 a share. Today, the stock is trading at $78 a share. So there's a big difference between those two. And that difference is the arbitrage, right? That theoretically, if the sale happens, you're going to get $95 guaranteed. And and you're buying it at $78, so that's a really nice spread. The risk component of it is the deal going to close or not? So what we're going to talk about is, we're going to talk about Activision Blizzard. We're going to talk about the factors that we know here. And we're going to talk about why I think it's a safe, relatively safe investment, and why when you consider all the factors, this is a risk arbitrage that makes sense. Now, you might think this doesn't sound like a value play, but it's very much a value play. Warren Buffett has done a tremendous amount of merger arbitrage over the years. And if you study him in any depth, you'll see that especially in down markets, he has made sometimes most of his profits by risk arbitrage operations. So we're going to go through all of this and help you understand what's going on and help you understand why this could be a fantastic investment for your portfolio. So here are the facts. On January 18th, Microsoft announced a deal to buy Activision Blizzard for $68.7 billion. This works out to $95 per share. And the current price of ATVI today, Activision Blizzard, symbol is ATVI, is $78.57. So you've got that nice little spread there. It creates a potential arbitrage of $16.43 or 20.9%. Now comes the risk component, and that's what we don't know. We don't know if the deal will close. We don't know exactly when the deal will close. The other thing we don't know is what will happen if it doesn't close. So the stock typically trades at a premium. Typically the buyer of a company will buy the company at a premium to where the stock was trading before the merger was announced. So for the sake of conversation, a company is trading at $60 a share. The acquirer of that company will often offer, say, $80 a share to buy the company. So if the acquisition is at $80 and the current price of it is $70, but the price before the merger was announced was $60, well, one could argue that if the deal falls through, your company's not going to maintain a $70 valuation. It's going to drop some. And so when we're looking at a risk arbitrage, what we're really doing is just figuring out a expected value probability. If you gamble at all, if you play poker, for example, you're familiar with this concept of expected value. The idea is if something good happens, if I get the card that I want and I make my flush, then I make several times my investment out of the pot. If something bad happens, well, then I lose my investment in the pot. And there's a small chance I'll make my flush and a large chance that I won't. And so we look at all those things and we put in an expected value and say, if I make this same bet 1,000 times, will this work out? Because over 1,000 times, the statistics are going to work out. Will this be a profitable play? The entire casino is based on that model. They know you can go in and beat them on any given day, but they know they're dealing, thousands and millions of hands of blackjack over time. They know they have an expected positive value on every hand. And so even though the positive value is very, very small in a casino, it's big enough. And so what we're going to do is we're going to treat this merger arbitrage analysis exactly as an expected value proposition. So here you can see a little spreadsheet that I put together. And this is the spreadsheet that I use to analyze a merger arbitrage opportunity. So you can see the first row across is simply Activision Blizzard, its symbol, and the current price. And that's automatically populated. So it's just every day that changes for me, right? If the merger happens, well, I know the buyout price is $95. I know the current price is $78.57. So the expected profit would be $16.43, which is a return on investment of 20.91%, which is very, very good. I think it will close in less than 90 days, which if you look at basically 21% return on investment, and it takes you 90 days to collect it, that's an annualized return on investment of 84%. I'm looking for investments that will do an annualized return on investment of about 20%. So this is a fantastic investment looked through that prism. But again, that's not the only prism. One of the things we have to consider is that it might also not happen, right? So if there's no merger, well then I've put the fair value at $67. And I believe that's a fair value. I'm gonna show you the chart for Activision in a minute, and you'll see why I think $67 is a reasonable expectation to where this stock will drop if the merger doesn't happen. So the current price for the stock is $78.57. That means if the merger doesn't happen, I'm gonna lose $11.57. That means I'm gonna lose 14% of my investment, which again means that it'd be a negative 59% return on an annualized basis. So the next thing we look at is chance for success. Now I'm going to go over in a few minutes why I think the chance for success is where it is, but I think this has got more than a 75% chance of going through, which means it's got a 25% chance of failure, right? So if you look at $16.43 and you multiply it times 0.75, that means my expected opportunity if it goes through is about $12.32, which is a 15.7% return. There's a chance of failure if it's got a 75% chance of happening of 25%. That means I've got an expected loss of $2.89, which is an expected loss of 3.7%. So again, what I have, if you look at the risk-adjusted expected value, you look at the chances it goes right and the chances it goes right, and you add those together, and you come up with an expected value of $9.43. That means if I did 1,000 investments and I assigned these same numbers and I was correct about my analysis, that I would make a profit on these deals of about 12%, annualized, which would be about 48.67%. So all I've done is I've simply said I've taken a bunch of facts, I've taken some assumptions and some analysis to try and come up with the price that will happen if it goes wrong and the probability that it'll close. And I've decided, okay, this seems to me like the kind of thing that ought to be earning me about a 12% return when you consider the positives and the negatives. So that's the analysis that I do, but it's not the only analysis that I do. I think that you have to be, when you're a value investor, you want something called a margin of safety. And a margin of safety is this idea that maybe I'm right, but maybe I'm an idiot or I miss something. And so I'd like to have a buffer zone where even if I'm wrong, I'm still going to do okay. That's the whole key to value investing, is you do all this homework like everybody else, and then you require this margin of safety before you finally pull the trigger, because you just assume you're not smart enough to think of everything. So I've put in here, what I've done here is you can see I've changed the chance of success from 75% to 60%. Okay, so when I do that, you can see that I still make the same amount of money and I still lose the same amount of money, but now my chances of making money have gone down and my chances of losing money have gone up. And you can see that my risk-adjusted expected return has now gone down to $5.23, which gives me a return on investment of 6.7%. Annualized, that's 27%. And as I said earlier, I like to have an annualized expected rate of return of 20%. So even when I've given myself a margin of safety, this still looks like a really good investment. But again, let's just say that I'm a complete idiot and there's another factor that I haven't considered, all right? So now what I've done is I've said, okay, let's take a catastrophic example. The lowest price that Activision has traded at in the last 52 weeks is $56.40. So I think it's reasonable to assume Activision is not going to drop down below that price. It's still a profitable company. It's still got high margins. It still has low debt, and it still has low these franchises. But let's just say it drops down to $56 a share. Okay, with a 60% profit, I mean, the 60% chance of the deal going through, now all of a sudden I'm making very little money, but I'm still not losing money. Again, if I did this 1,000 times and it works out 60% of the time and it doesn't work out 40% of the time, even with that big a loss, you can see that I still have about a 5% return on investment. Nobody wants to invest with a 5% return on investment, but this is my most pessimistic example of what I think we could get. And when you look at that, you still see a positive return on investment. Now, as we're looking at these numbers, for example, you could say the chance of success is 50-50, but if a chance of success for a deal is 50-50, I just am not going to invest in it, right? I have to believe there's a better than 50% chance of a deal going through, or why bother? I just go find some other investment. So the lowest I'm going to ever invest in is something where I can't imagine it not having a 60% chance of happening. Now, there are some things that are happening out there in the market that have given me additional reasons to believe this is going to go through. And they're the things that give me this 75% probability. And these things that make me very, very comfortable with it's a better than 60% chance of happening. The first is this is a mature deal. This deal happened on January 18th. So if there was going to be an antitrust problem, that would have reared its head by now. If there was going to be an FTC problem, we probably would know about that by now. If, with Microsoft, we don't have to worry about Microsoft getting financed because they've got, I don't know, 150 or 200 billion in the bank. I haven't looked at it recently, but it's a big number. They can clearly pay cash for that. So I don't have to worry about financing falling through. Another thing to think about is that Warren Buffett owns 9.5% of ATVI. So not only have I looked at this and think it makes sense, but the person that I've modeled my entire investment philosophy on has come to the same conclusion I have. And by the way, he came to it first. I'm just copying him. But if Warren Buffett thinks it makes sense, that lets me sleep easy that he's done the same math I have. He may have come to different conclusions, but not materially different conclusions. Also, Warren Buffett bought in at about 67. It's about 78 right now. So he could have sold and made a 25% profit already, and he continues to hang on, which I think means he believes it's going to close. That's a fantastic set of data. Now, the other thing to know is that one of Warren Buffett's board members and his very good friend is a guy named Bill Gates. And Bill Gates has a passing relationship that you may be aware of with Microsoft. I don't believe there's any insider trading there, but I believe that Warren Buffett has spent enough time with Bill and has spoken with Bill enough about what Microsoft is doing in gaming, because he's just interested in business, that he has some sense of what Microsoft is trying to do there and why this would fit into his portfolio. And so while I don't think he has any inside information if the deal is going to happen or not, I do think he has a more thorough knowledge and a better circle of competence in this category than most of us. Another thing that I think is really important here is the CEO of ATVI stands to make $400 million if the merger happens. So the CEO of the acquired company is highly, highly motivated to find a way to make this happen. So Microsoft wants to make it happen. They've written a check. They've signed a merger agreement. They're all in. But sometimes you're doing a hostile takeover and you're working against the forces on the inside who might be trying to scuttle the deal on the inside or from behind the scenes. I don't think that's happening with the CEO of ATVI. That makes me feel very, very comfortable. Again, it appears there have been no antitrust issues with this merger. It also appears we have a liberal president in the White House, and when the White House switches from one party to the other, it's generally believed that a Republican president is good for mergers and acquisitions, and a Democratic president makes it harder to get mergers and acquisitions done because these agencies, the FTC and the SEC and the Justice Department, tend to find reasons why the merger shouldn't happen because they're not as pro-business. Maybe they dig deeper. In this case, we know that there was some concerns about the union at ATVI, but we understand it's just come out, and I'm going to tweet a couple of these articles. But it appears that the union for for ATVI has written a letter to the Federal Trade Commission in favor of the merger, which I think might be the last thing before this deal happens. Another thing to note that I don't think people pay attention to is that Microsoft isn't really paying $95 a share for this stock. And that's because ATVI has a very significant cash position. They have $11.3 billion in cash. They have $3 billion in change in debt. So that's $8 billion of net cash, right? They could pay off all their debt and have $8 billion left. Well, when you acquire a company, if you own stock in a company, the cash they have on the balance sheet does you no good. Unless they decide to pay a dividend, you don't control that at all. But when you buy a company outright, you also get all their cash. And so while they're paying, I think, $68 billion for the merger, they're getting $8 billion in cash back. So that's 8.4% of the purchase price that is just sitting in the bank. The minute they close, they get that money right back. And that means that their real purchase price to purchase the stock isn't really $95 a share. It's $87 a share when you net out the net profits that they get, the net cash that they get back when they close. And that means that Microsoft still believes they're getting a pretty good deal in this company, in my opinion. So I think all things considered, the last thing to keep in mind is, let's just say that it tanks and it goes to $56 a share. The deal falls through, it goes to $56 a share, and I'm stuck holding this dog. I don't really think it's a dog. At that price, the PE ratio of the company is about 15, and I don't think I mind owning Activision at a 15 PE. And so while I don't love it, and I wouldn't want to have bought it, knowing it was going to drop that much, the fact that it's dropped that much, I think it's got a lot more upside than downside, and I think over some period of time, I get my investment back. It might just take a little while. So when you add all those things up, you get a sense for why I think Activision Blizzard is a great thing. You're going to be hearing a lot more from me in the coming weeks. I've got a whole bunch of stocks that I think are good things to buy. And I've also got some news that I'll be talking about in future videos. So that's it for me. That's it for Activision Blizzard. The last thing you should think about is this merger is likely to happen very, very quickly. I think it could happen by the end of the month, maybe the end of the week. So if this is something that makes sense for you, do your homework over the weekend and buy some stock on Monday, because I don't know how quickly this thing's going to close. And once it closes, this opportunity is lost. Thanks.